We'll do it live.
Okay. No.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back everyone to Capital Mindset Show. Let me go ahead and check our audio. So we should be good. I don't think any of my settings would have changed since the last time we've did a live stream. So it's been a while since we've done any public content and I'm excited to be back. Let's get right into the discussion. So if you guys look at the description below, I already put in the timestamps. That should help guide us through. We got a lot to really talk about, honestly. And we're probably going to delve into some things that are not listed down there, as it always is. You guys can help guide the conversations with questions, etc. All right, so let's get political. I'm just kidding. Well, we obviously went through an election. We have a new president. This is the first time that at least Donald Trump has been president during us making videos. So, you know, that's new, but he's obviously been president before. And, you know, I won't bear the lead here really with what's, I guess, to be expected. Should it change your investing strategy? I don't really think so. There could be some thematic changes here and there. And, you know, as you guys know, I know many of you familiar faces, you already know more or less the thematic changes that I may have, you know, elected to take part of. But holistically, you know, bird's eye view, longer term strategy, really nothing has changed all that much. Of course, in the interim, and we can talk about some of the you know, bubbles that exist out there in certain markets that look maybe like interesting shorts or anything like that. I do think some things have gotten a little bit more excited than others, mainly crypto, the rise once again of meme tokens that echoes of you know, 2021. We probably, well, I at least didn't think we were going to see that again. So that's frankly a surprise. That really took me by surprise, if I'm being honest. But, you know, it is what it is. And we have the rise and somewhat fall of Fartcoin. I haven't been keeping up that much with Fartcoin. All I know is that it at one point was up quite a bit. We also are going to talk about different individual stocks, and some of them for the club members, they're older investments. But I want to talk about them publicly and actually dive into each one. Some of them are updates that, you know, we've covered in the past, like Netflix. So Netflix reported earnings, so I wanted to take advantage and talk about it. There's a lot to get into that one. If you guys haven't seen the videos, you can go check out the videos on Netflix, the original pitches back in 2022, what I liked about Netflix. So that should be providing a decent update. Spoiler alert, it was a good earnings. The market said it was a good earnings, at least. I think it was a good earnings, but we'll talk about whether or not I'd be adding to the position or if I'd be, you know, staying away or looking to sell. All right, so I'll be periodically looking over here to see if there's any questions. And if there are any questions, just throw them at me and I shall try to get to all of them. Hit the thumbs up. Thank you, Andrew. And I'll give a shout out to Andrew if I talk about some of the, you know, bubble stocks out there that look like potential interesting shorts. All right, let's get into, I could say, not a specific stock yet, but the first thing, which is covering the Donald Trump presidency and sort of the strategic shift or some of the themes. Well, for one, I think that you want to look for stuff that plays into anything that is enabled by mergers and acquisitions. So there's a lot of ways to play that. There's investing in boutique elite investment banks. There's the large investment banks. There's law firms that are out there. There are also, you can play it in the asset manager space. So there's a lot of ways to actually get exposure to that theme. And I think that theme is going to work really well. If you look at the high end or the top end of that theme, the largest asset managers, they've done really well in the past year, and sort of towards the bottom, there was a bit more lumpiness in that performance. Some of the specialty asset managers have done okay. You could look at some of their charts, and I'll actually point out some of them. And you know what? I'll share this one with the public audience. BRDG, which is a Bridge Investment Group. So this one had kind of a rough or lumpy last year, not rough, But at one point, it rallied all the way up to where I assumed was roughly fair value. And it had done so in quite a rapid succession and then quickly came back. All right. So what is Bridge Investment Group for those who are not, have not been introduced to this company ever? This is a private equity firm that specializes in real estate assets. So they're a leveraged exposure play to real estate. You could think of it that way. It's a $800 or $900 million market cap company with a AUM of about 50 or so billion dollars in real estate. So you could buy, a REIT, or you could buy something like Bridge Investment Group. Gives you similar exposure, and then you can think of some of the risks are also overlapping, such as its exposure and sensitivity to interest rates. If you guys know, if you look at REITs, if you take a look at the VNQ, or actually it's better exemplified by some of the popular names. Let's take a look so we can see a little bit higher volatility here, because some of the residential REITs have done okay, but these ones who are some of the more popular REITs out there among retail investors, Realty Income, Triple N, SUI, Rexford, some of these industrial, this is a retail REIT, specialty real estate companies, they've done fairly poorly and kind of correlating to where the 10-year has been going. So 10-year yields have been going up, and subsequently the prices of a lot of these stocks have been coming down. And that makes sense, because when you're judging the cost of capital for a lot of these REITs, and all that a REIT is a business model that tries to generate a spread between the cost of capital and the acquisition price of a rental property. That spread is the profit. That becomes a little bit more difficult. And then something has to give. Either the cap rates have to increase, or the cost of capital has to come down. If the cost of capital is going up, then the fear is if the cap rates don't come down, the growth stagnates. And what do you pay for that when growth is, frankly, shrinking or contracting? So that's been a big challenge for the real estate sector. And something like Bridge Investment Group as an example is an overlap of a couple of those themes. But frankly, the top asset managers have also been still fantastic performers. They almost haven't noticed the pullback that some of the other asset managers had in the secondary space. But we're on the top end, we're talking about KKR, Apollo, Ares, Blackstone, and the like. So that's one way, again, the one flavor of playing that. Banking is one other theme that seems to be very popular now. So some of you have some bank holdings. Maybe it's a U.S. Bank Corp. Wells Fargo finally vindicated. I remember making videos on Wells Fargo back in 2022, and they've been in the penalty box for a very long time. They're finally out. So it looks like Wells Fargo's future is bright, but it's priced now accordingly. JP Morgan seems to also be doing very well. And then also on the lower bound of banks, if you look at the regionals, the small specialty banks, they're also doing really well. So these themes are now so far kicking off to a strong note in 2025. And a lot of that optimism stems from the Trump presidency. I guess you could also kind of caveat that, and we're going to talk a little bit more about this later on in the episode or live stream, and that's going to be about AI infra and the developments around that. And regardless of how you feel about it, I'm talking more about the sentiment. So we can have a debate about the raw numbers, and I think there's another discussion we could have about that. But with the sentiment, at least for the part of this segment of the live stream, the sentiment definitely has improved around AI infra, even though you might argue it was never bad. It just got a little bit more exciting. So more euphoric, let's say. Okay. Long time no know. Oh, we are going to talk. I think now we're into the section where we're going to talk about the Chinese AI. So China, yep, we're exactly on time. So China released, or a company in China released their open source LLM. And that supposedly is in direct conflict with Meta. I have no idea why Alphabet's having trouble displaying Meta's chart. But anyways, it's supposed to be in direct conflict with Meta's strategy, go-to-market strategy, which is an open source model. So Llama is supposed to be an open source product. And this new one coming out of China is also open source. And it seems to be almost like it's stolen the weights from ChatGPT. So debatable on, well, I guess we can get into that conversation now. Yeah, let's get into the conversation now. So if you notice that the stock price of Meta didn't really react to that, and some of the debates I've been having with people online, Twitter, you know, and within the club, has been stemming around what the perception is, or this debate around AI spend. And I think that there's a lot of and actually, let me start sharing my screen here so we can start discussing and having something here for you guys to look at. Well, right now, actually, it's funny. Meta's not, you know, showing anything. So we'll do Alphabet. Just so you guys have a chart in front of you. But I wanted to talk about Meta, because Meta is the one that's more in direct conflict. I'll make myself a little bubble here. Okay, so pretend that there's Meta in front of you, or you know what? We'll just go to like I don't know, a website, a different website, just to have Meta in front of us. And I'll just zoom into the chart. Actually, we'll use this one. I think we can get a clean chart. We'll not use our new sponsor. Wink, wink, nudge, nudge. That's a joke. All right, I want to do I'll just do you a 1 year chart. I think that exemplifies it. All right. So I wanted to have Meta. I was stubborn about it. So Meta seemingly does not care. Why doesn't the market care? Well, there's maybe a conversation we can have about the distinction between accelerated compute and LLMs. So a lot of these companies, Meta in particular, has often been saying we're spending this much on AI infra, AI infra, AI infra. And then so the word AI is very loaded, and a lot of people have different opinions about AI. Some people have you know, the opinion that, or the perception maybe, that it's only the LLMs that they interact with. So if I open up, you know, Instagram, I open up WhatsApp, and I start chatting with the Llama AI model, or the Meta, the Llama language model on labeled Meta, you could see it on your Instagram. If you just go to your search, you'll be able to see it right there, and you can interact with it. They think that's, you know, what the AI investment is. And if you guys recall back in 2022, you can check out the video. It should be titled "Meta is Uninvestable Broken Trash." It's meant to be ironic. In there, I actually go over Meta's presentation, and they discuss the spend. And you can remember, if you guys remember from, you know, CNBC or whoever, a lot of people were saying that they were spending on, you know, the metaverse, and that they used images of the digital avatar of Mark Zuckerberg. I think I even used it in the thumbnail, by the way. And they were saying, look, he's spending billions and billions of dollars, and this is what they've come up with. It's terrible. What a waste of money. In fact, that couldn't be further from the truth as to what that capital was going into, and the internal tool sets that Meta was developing to improve the platform and the ad targeting. And so these are some of the real world benefits that they generated from that spend. Now, in let's say the conversation of just Chinese AI, if you perceive that all of that spend, which is a lot, if you look on Twitter, that's a lot of what people are saying. They're saying they spent billions and billions of dollars on this LLM, and then China comes out with one, and they say they did it for like $5 million or whatever it was. So that's assuming that when you're saying AI, you're just saying it's just the LLMs. It's that, again, couldn't be further from the truth. And a lot of people say that the spend is useless, and I'm like, okay, let's accept that argument for a moment. Let's accept that the spend is useless and it draws no net new benefit to, you know, operating cash flow. And I try to stick to cash flow for the argument instead of GAAP earnings, so we remove the discussion around, you know, depreciation and capitalization. So sticking to cash flow. And then if that CapEx, if we assume it to be of zero net added value, then we should see, if that CapEx were to fall off and drop off, then the operating cash flow should stay the same, because you're saying that it's useless cash flow. And so then by that same token, that person is then arguing the Meta's cash flow margins are extremely high and suppressed artificially, which I disagree with. I want to start by saying that I disagree with that. I think Meta's margins are great, right? It's a great company, blah, blah, blah. But the margins are not that great. They're not otherworldly. it's above average. It's a good margin rate, but it's not what the implied argument insists, which is they are producing all this cash flow, and then they're spending all this capex on useless spend that's not driving any benefit, driving profits down to the bottom line, or in this case, to operating cash flow. It's not bringing in a lot of cash. So that all being said is like where I think the market sort of sees this like challenge to Llama and doesn't care, right? Because it's never been about the LLMs. The LLMs are the way that we can interact with, like the everyday person can interact with a artificial intelligence, let's say in quotations, and that's to the extent of it. I don't see why a lot of people are insisting, and they go out of their way sometimes to say, okay, but they're lying about the improvements. And I'm saying, okay, so the improvements are for something else. So I'm looking at the numbers telling me that there's an improvement going on. Then management is saying there is an improvement going on, and this is why. And then I just have to assume that they're lying. So there's a lot of jumps I have to do to then conclude that. Versus it's just likely there's improvements. I see the improvements in the numbers, and then management says we did these investments, and then that is why those improvements are occurring. Okay, so there's a lot of leapfrogging I have to do to conclude the latter. So that all to be said is my explanation or my interpretation as to why, something like Meta is not falling on the LLM news. And I've been going back and forth here and there because there's been a discussion about, well, there's an AI premium assigned to these guys. And then there was a question like they rise and fall based off of news on LLMs. And like, what did we just see? This is actually a good moment to take a look and see. There is a threat in the AI space in China, right? They just did it for free. Why isn't Meta falling? Because I don't think the market's that dumb. The market can be dumb sometimes. Absolutely. I agree with that. But the market's not dumb all the time, guys. It's unfortunate because I wish it was dumb here and it would sell it off a lot. And again, I almost say if someone's arguing that the AI spend was useless, you're basically telling me I should buy leaps, like crazy quantities of leaps, because at some point when the capex drops off and the free cash flow just balloons out of this world, that's what you're implying is going to happen. And if you recall, that was a lot of the thesis of Amazon. So my Amazon video back in 2022, my Salesforce video back in 2022, that was the pitches for those. It was predicated on these companies that can just turn on the spigot and cash flow can just pour out because there's a lot of efficiency gains that they could get, and they have gotten. And so now you see how the narratives have changed with a lot of these companies. In particular, I think Salesforce is now back to being a darling. I think everyone's like, oh, Salesforce is dead. Now it's like, no, Salesforce is not dead. So it's funny how things change. And I think the same thing has happened to Netflix. I mean, gosh, a lot of you guys have been following me for a long time. I mean, in chat, I know some of you were there during 2022. Come on, what was the narrative in 2022 about Netflix? Oh my gosh, how many times in the comments would I get people saying Netflix is a terrible platform, it's dead, blah, 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 blah. So we're going to talk about their user growth because their user growth came out and is impressive. So let's actually get to, I think we're on the next topic. Okay, no, we still have time. So let me go through some questions and then we'll get to the next topic. Oh, okay, so I see some questions in here. Why are people acting like it's as good as USA AI? I don't know, Gil. Hey, Gil, we're in agreement on something. What's going on? Well, I retweeted someone's tweet because I think that's also something to think about. It's like, hey, crazy idea. What if China's lying? Wild thought, right? I know I can come across sometimes as a China hater. And it's funny because I think a lot of the club members who are of Chinese background or origin will actually be the ones who agree with me sometimes. And it's kind of funny. But we had some instances, let's say, in China recently, and since we've at least been doing videos on YouTube, about the 100 million people, recall that? There's been quite a few instances of, a little bit of fibbing, right? But yes, so I retweeted something along those lines. Crazy idea, but okay. And there was another question, I can't find it now. I was scrolling up and I was like, I'm going to address this. They think AI will displace jobs. Oh, I guess that's to someone else. That's not to me. Do I think AI will displace? It will displace some jobs. Hell yeah, Gil. I'm happy you're happy. Have this. This man said spigot. This is a chemistry class. Is this a chart of Fabio's port? Last year was very good. This year so far is very good, but it's too early. Wait, Fabio is actually live. You didn't know it was actually live? You thought this was a recording, like one of those already pre-filmed, and then we just no, this is actually live. All right. Did you look into Bloom Energy? I have not. I saw that, and I'll get there. Why does he hate China? I don't hate China like the Chinese people or anything like that, and I don't hate China. I just look at a lot of the things as being problematic, and that keeps me away from investing in it. And I was doing that before it was popular to do that on YouTube. I have the videos on YouTube to show that. So China has always been a contentious topic where the Western investor applies a Western normative mindset into investing within other markets, and it happens a lot over and over and over again. I think especially a lot of club members who are very internationally inclined have started to appreciate that, because that's something we've tried to instill in everyone, is like when you're doing analysis on businesses in other countries, try to take a nuanced lens and appreciate that their business culture may be different than that of the country you're from. And so this is not like just a Chinese issue, but in particular, China has very particular issues that are unique to China, which make it, to me, and has always made it, uninvestable. I think it's fine if you want to speculate with like joke capital on sentiment movement, because there's been a periodic pattern of the Chinese government coming in and saying something to appease the Western investor. I call it the coddling effect. They coddle the Western investor in their hands, and they try to make them feel good in some fashion and encourage capital to come in. In fact, recently, I think the vice president, I believe it's called the vice president position, I forget, but the second in charge under Xi Jinping, he had a meeting with American business leaders trying to encourage them to invest in China. The fact that there are even people still, still encouraged by that fact is, God bless them in that sense. But there's a lot of signs for, let's say, weaknesses in the system. We can look at capital control restrictions. That's not typically a good sign you want to see from a country. That's actually a sign of weakness, not a sign of strength, because they have to basically limit the amount of capital leaving the country. Otherwise, bad things can happen. And some of the recent, let's say, bond sales are more indicative to me that they're starved for dollars more than anything. But that's more of a consequence of their own system itself. And despite being the second largest economy, they have a very low settlement rate for their currency, because most countries, when it comes down to it, don't want their capital. And also Hong Kong being such an important central banking hub for them, because that's the way that capital can flow in and out of China smoothly. Otherwise it can't. So that's already a problem too. There's a lot, and we could actually do a whole live stream, like quite literally several hours talking about it. But right now, I just looked at the time and I have to move on to the next topic, and that is Talon Energy. So we're going to come here and we're going to talk about Talon Energy. So Talon was, I don't think I've talked about it publicly on YouTube, but this was a pitch in the Capital Mindset Club last year, and it's done very well. It actually stemmed from a club member who brought it forth and said, "Hey, this looks like a good idea." At which point, that's basically how a lot of ideas originate. It's a group collaborative effort, and a lot of people collaborate on the research. They find different things, put it together, and I initiated a synthetic long position, which in English just means I sold puts and I bought calls. And so this has been one of the biggest winners at the tail end of last year by percent gains, as well as it's done fairly well this year. along with its peers, VST and CEG. So I'll go ahead and put them next side by side. And I'll talk a little bit about the nuances there. But in short, Talon Energy is the cheapest of the three. They actually are the business that came out of bankruptcy. I believe at some points last year, they were outperforming VST. They had an uplisting in the middle of last year in the summer. So that's actually when the contracts became available. Before, you could only buy shares, and you were buying them on the OTC. They got uplisted to the NASDAQ, and now you can buy shares, you can buy contracts, sell contracts, etc. You can do whatever you want. So in short, what are they? They're an independent power producer. So in English, they make energy. They're supposed to not be constrained to the whims of regulators in the same way that a regulated utility is. So, kind of a difference there. Let's think about Duke Energy as the regulated utility. The regulated utility maintains infrastructure. Talon Energy invest in the productive assets that produces energy. Think nuclear power plants, gas power plants, coal power plants. They produce the energy and then they sell it onto the grid. They participate in auctions, and recently they've been signing co-location agreements. What does that mean? That's agreements with someone like a hyperscaler, let's say Amazon, and they say, we're going to give you an agreement for energy to secure this energy providing to your data center, and we're going to agree upon a price. So we won't raise that price, we won't lower that price. This will be the price. So you'll know what price you're going to be paying for that energy. And so Amazon, and that's the actual company they're making this co-location agreement with, has been attempting to expand the agreement in place that they currently have at their nuclear power plant. So Talon Energy did something that was very interesting. They built a facility and then they sold it to Amazon. Amazon took over the facility and then they did sign an agreement with Talon Energy and then have been attempting to expand the agreement. And that's actually, if I tell you the story, let me actually remove the other tickers. So the sell-off actually over here, which was actually the last, I call a good entry point before we just took for the races, was the regulators basically coming in and temporarily, or at least for now, it was a rejection for that time period, basically saying, we'll figure out whether or not we accept this in the future. So that was what I recall now, and in hindsight's 2020, but that was like the buying opportunity. And there was a lot of people that were shaken out, both, within the space of people that follow this. But we're fast forwarding to today. We have a couple catalysts ahead of us. We have the auction in the summer. I forget exactly what month it is, but it's in the summer. And of course, we have further pursuits by Amazon to get that agreement expanded upon. So they didn't give up. That's a good sign. I look at Talon Energy, and this was the thesis at the time. Well, for one, they are the cheapest of the three, right? Granted. Two, they were trading at a valuation that when I looked at it, it appears though they were trading at below replacement cost for the assets that they held. The asset in particular, that's the crown jewel, is the nuclear power plant facility. And one caveat is they don't own 100% of it. They own 90% of it, but basically they own the vast majority of it. With that, the replacement value of that, is debatable. We don't have an exact number, but typically it can take, always over budget and overextended, how long it can take to build one of those assets. So the replacement value could be in the tens of billions of dollars, which was way in excess of the market cap. One other thing that I liked about Talon Energy, and this was part of the pitch, was like Vistra, they are not going to go in an acquisition spree. They're going to focus on doing one thing: buy back stock. And so as long as they continue to do that, I think we're in ball. And then they could be an acquisition target by the likes of Constellation Energy, the private equity firms that I mentioned earlier, because they probably would like to get in there. If you've been paying attention to Blackstone, they've been saying this here and there. Hey, we are potentially interested in seeing what we can invest in our infrastructure funds for energy around, and I'm paraphrasing, that's not exactly what they said, for addressing the energy shortage for data centers. So I think it is a likelihood that they get acquired, but the thesis has to work on its own. And I'll be honest with you guys, I don't view it as like a forever hold because, and I'll say this here, I consider the thesis to have worked already, and we're just kind of like writing it out to see when we exit. And that's the key. I don't think I'm going to exit at the exact top, but I don't think United States is going to have perpetually this sort of energy shortage. In fact, if you look at a lot of the power crisis, a lot of it's caused because we closed a lot of power plants. And some of the members have pointed this out when they did their due diligence. They said, look, if you look at the data, it looks like we have shut down a few gas powered plants, coal power plants, and the solution might be just to, bring them back online. And there you go. Now you have power. You have a lot more power than before. Because if you look at trends showing the power consumption capacity, power capacity and power consumption, we haven't had a problem for a very, very, very long time. A lot of that exponential growth is done. And in fact, we've outgrown our power capacity versus relative to our consumption by the comparable rate. And in the past, it was maybe more so of a opportunity for, growing power because demand was growing so much, but we've gotten a lot more efficient as well. All that we're doing is we've been reducing supply, and then that's caused the imbalance. But a lot of the hyperscalers, they want nuclear power. Okay, so they want nuclear power, and they're worrying a lot about what power is supplied. So it's not just power is power. They want a specific kind of power. And even for some of their projects, they're wanting to build out their own nuclear power plants to provide this power. So yes, that's Talon Energy. And I granted, I'm kind of just enjoying the ride now. I'm not adding to the position at all. And hopefully I can be tax efficient with the position, i.e. I can sell it for long-term capital gains. But we'll see. We'll see kind of what the market provides to us. And yeah, that's Talon Energy. So I'll see if there's any questions. Otherwise, I'll move on to the next section. Yes. Okay, so I did mention in the past. I forget if I mentioned it or not. It's been a long time. Oh, well, I don't like it because I want him to get rid of capital gains for stocks. then we're in business. But yeah, no. For US based crypto, I mean, I doubt he'll be able to get that through. Do you think having a tiny allocation in China is on the off chance a major policy change in the future? Yeah, no. I mean, any allocation you think you want, as long as it's small and you acknowledge risks, I think is fine. I'm not going to tell you that having a speculative position is dumb. You can have a speculative position. I can't bring up your comment, but will that industry? Maybe there's always a joke that every industry that's developed is just meant to, grow that industry. So, yeah. Nuclear power, new nuclear, no coup, lar. I'm for stocks too, but he seems to only want to do it for crypto. Right now, he's got crypto. He's a little in love with crypto. I don't know why. Love how well you structured your stream. Is strongman cash flow kings. Everyone is weird bubble. Should take notes. Oh, okay. Thank you. Yeah, I try to when I have the time right before the stream. I like to. It's also for me, so I'm, not jumping all over the place. Okay. I think I am on to the next topic. We're a little bit late. Okay, but let's get into the next topic. So we're going to talk about Uber stock. All right. So Uber. This is another one that I have a synthetic position in. Again, for English, just in case people joining in English, all that means is selling puts, buying calls, right? Synthetic. So Uber Technologies gave us a pretty interesting opportunity not too long ago, and I think it's still in that opportunity zone, by the way. So I know that Talon, I was talking about it, and it's kind of, well, in my opinion, exit at least my threshold of opportunity zone. Some people might think there's still meat on the bone. I can see that still, by the way. But Uber is one that I still kind of actually think still has meat on the bone for sure. All right, so let's talk about Uber. Uber is, well, I don't think it needs an introduction. You guys know what Uber does, so we'll skip that part. But it's ride-hailing business. Anyways, so the different business lines of Uber, all of them are kicking on, I think, on all cylinders, if I'm being honest. The one caveat I'll say is Uber Freight. That one is still up in the air as far as like how good that business has in terms of potential. I frankly, I don't know. I just don't know. But you can kind of put that to the side. And I think the core business on its own is good enough to kind of come up with a somewhat of evaluation. There is one thing I will say. The insurance portion of Uber's business, which doesn't stand out, and a lot of people don't talk about it. I actually never hear anyone talk about this, is something that you kind of want to pay attention to, because a lot of their free cash flow is sort of contingent on the continued success of the insurance business. Now, the insurance business, what am I talking about? So Uber does a lot of its own self-insurance. So every part of every ride, they allocate that as a portion of insurance. And this actually suppresses the earnings because they actually over allocate to the expense portion. So they're basically saying, oh, we're going to actually expense this much in insurance. And then in reality, what happens is they expense a lot less. And so that gets added back, that gets reconciled as gains later on. But if you have a business that's growing, then therefore, if you have that situation on, let's say, a high growth business that Uber's still kind of in, the earnings are always going to be delayed to cash flows. And then there's other things, other line items that can cause that same imbalance. But again, over the long term, they will match, they will converge. But yeah, kind of just looking at Uber's free cash flow, looks interesting. One thing I will say that's kind of funny is that, and this is something me and the club members were talking about. We always joke sometimes about, oh, markets are perfectly efficient, blah, blah, blah. Because the CEO in the last earnings call last year said, yes, next year we're going to be doing a lot of share buybacks. You can go check this, like go check this yourselves. Go to the last year's earnings calls and you would hear the CEO say, next year, our capital allocation is we're going to accelerate these buybacks. So literally this jump here. So we were accumulating Uber, and then suddenly this jump happens. What do you think that jump was? That jump was off the announcement that they were going to buy back stock. I kid you not. I kid you not. So that's where that joke comes from, or adds to the joke, I guess. Oh, markets are perfectly efficient, because literally just by listening to the earnings calls before, it's almost like the market's like, oh, I'm not going to price it in until it's an official press release. But the management was telling you very directly, next year, 2025, we're going to be accelerating our share buyback program. We're going to be focusing a lot on reducing share count. And then suddenly on this day, press release gets announced, the buyback. Surprise, market surprise, boom, goes up. I don't know. Because I was frankly disappointed, because I actually was still hoping Uber was going to fall more. And I was a little too greedy to add into the position. But, it did what it did. But I still think it's $8 from the low, $8-9, because I think it hit like 58 at one point. I still think it's fine. So what are the risks for Uber that everyone's talking about? Of course, it's driverless cars. Driverless cars are going to take over the world. Of course, the technology is very exciting, but I think the other narrative that Uber is going to be the demand aggregator for the driverless cars is a very likely outcome. So Uber can be the place where several driverless car platforms are operating under and can get that customer to the car. There's going to be there's going to be a lot of competition in the driverless car space. And in some cases, like I guess the great example that we can think about is Hilton Hotels as a business, HLT, and Booking.com. Okay, I think that's a good way to start thinking about this. So you have Hilton, that is this branded hotel business with tons of properties all around the world. You can book directly through Hilton. There's nothing stopping you. Nothing stopping you from just going directly to Hilton and booking with it. But Booking.com is a very successful business because what have they done? They're a demand aggregator. They get all this demand and they funnel it through and they make the others compete for your business. So in the case of Marriott, Hilton, which are all great businesses, Booking.com is an equally good business on the sidelines that doesn't own any of the hotels, but they're a demand aggregator. And in many cases, I can't really say definitively which business I think is better. I think both are great. Like I genuinely think the franchise business for hotels is a great business, great margins, etc. They trade a little expensive, but they deserve to be, and many argue. And then Booking.com is also a great business. Also kind of plays in, let's say, the more attractive side of hospitality. Unfortunately, the REITs, they're not in the most attractive side. They're in the risky side, but it's neither here or there. So continued dilution of shareholders. Growth is off the charts. Uber. Fabio is doing an inverse JPM collar statistically. You get black swan. Yes. Sublink. Lincoln citing 2025. MSTR pyramid scheme. We can talk about that. California law, 1.2 million mile incident free to have street legal driverless. That is the moat that's implied. And Jim, are you talking about Uber? I think you're probably talking about Uber. Like a Turo kind of, yeah. It's Uber. What am I getting? I'm getting some ads. Oh, let me send an invite. Okay. Oh, and there's apparently new news. I forgot to mention this in the beginning. The president has been negotiating with TikTok to get a deal signed where they are sold to Oracle. So that's just in. And Oracle, more so as part of the broader conversation, we're going to come right back to the topic. Oh, I can't type Oracle. Oracle has been top of mind recently because they've been very involved with SoftBank, who's been saying they're going to invest about 500 billion US dollars. And then, of course, the drama continues with Elon Musk saying they don't have the money. Where's the money coming from? So I'm not going to stake a claim in either case, but I think what it tells you is that the demand for spending is still there. And so if you play this right, you can still make a good amount of money. I mean, if you haven't been in those themes for the last 2 years, your performance may not have been as that stellar, but that theme continues to go strong. Now, will it go strong for a fourth year? Maybe, maybe not. I have no idea. Some people, of course, get late to the game and they'll get what they get. Okay. Hilton is randomly, I mean, it's a fantastic business. Okay. Red Note stream when? Yeah, you'll find me on Red Note for sure. For sure. All right, let me see how we are on our schedule. Okay, we have to go to Netflix. So Netflix, again, I have quite a few videos on YouTube covering Netflix back when it was interesting. Right now, you just basically get earnings updates ever so often. So market loved it. Let's go over the notes here. So Netflix. Revenue of 10.25 billion, 16% year-over-year growth. And we had EPS of $4.27. The more interesting note is 19 million subscriber additions in the quarter. I love to see this because let me remind everyone, when we talked about this Netflix back in 2022, and they basically deleted all of Russia users, that was actually a narrative that was floating around that Netflix is not going to be able to grow, right? They're not going to be able to grow. And by the way, I recall no one mentioning that as the reason for the drop in subscribers. Everyone was just looking at the drop in subscribers and saying, oh no, this is terrible. And then of course the password sharing crackdown, for some reason, people saying that the content sucks and no one watches it, even though I think every single month, the top 10 shows, 7 out of 10, 8 out of 10 would be Netflix. And even since then, I think it's even more exaggerated now, with HBO on occasion coming, or sorry, they call themselves Max now. Max coming on occasion with something that hits in the top 10. Disney, almost never. And then Apple, actually frequently sometimes gets 1 or 2 in there. And then Amazon really does get some in there. So it's almost been like Amazon and Netflix dominate the top 10 year in and year out, or month in, month out, not year in, year out, month in, month out. And I think that's also some misconception that people have with Netflix and kind of using a proper comparison. People use Disney to compare it against Netflix, and that's not, I think, a proper comparison. One is a decentralized approach. The other one's a centralized approach. So Disney is very, very, very top down, meaning that when you have bad culture near the top, it trickles down and infests every project or most projects. And so you have the exception is a good project, and then the majority is just what Disney produces. And then when you have Netflix, what you have there, and we've talked about this in the past, is creative destruction. So that is a decentralized approach, a decentralized strategy. A lot of people complain that it brings in a lot of bad stuff. And it's like, yeah, but that's the point of the strategy. A lot of bad will be made, a lot of good will be made. It's the point of the art form, creative destruction. You try out new things, some work, some don't work. And so that desire, that strategy to go that direction has enabled a lot of their success. And they honestly, I don't know why Discovery just let them win, because Discovery, which is now part of Warner Bros. Discovery, they dominated the reality TV shows, and Netflix just took it over from them. I can't explain why, but they just laid down and died, and Netflix took that from them. Netflix then got into sports. So all of this is kind of pushing new boundaries for the business, and there's no signs of stopping. Now, valuation. Well, the valuation was totally different back in 2022, and it was probably still arguably fairly valued all the way through. And now we're getting into territory where I can't really justify it, but I don't want to pay the tax bill. And frankly, I in my personal holdings, I don't know what I don't see like right now another super compelling idea that makes me want to sell Netflix and then buy other thing. I might sell contracts on the position, but nothing that makes me say, ooh, I really want this other position that bad that I'm gonna, take all of this capital from Netflix and then throw it into that idea. If there is something that shows up, that I'll probably talk about it in the future. But for the time being, that's kind of where I'm at. Now, the other point I wanted to make sure I address is the advertising bit, because that was the more latest, I guess, exciting part of their business, showing really promising signs. The ad supporting plan is now 55% of all new signups. Ad membership increased about 30% quarter over quarter, so really strong growth there. And we see ad revenue doubled year over year, and we expect to double again in 2025, said management. So that business is firing on all cylinders, similar to like we always point out with Amazon ads. Amazon ads is firing on all cylinders. Amazon ads, like I said, will achieve or will grow to the size of Meta of 2022, not the Meta of now, but the Meta of 2022, and they're on track for doing that. Netflix, I haven't actually modeled out what I think Netflix's ads would do. I've been pretty lazy with this position, if I'm being honest. But yes. Okay. What is Ackman's cope is hilarious? Oh yeah. I can imagine. I can imagine. Blah 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 narrative designed to get you to panic or FOMO. Oh, the yeah, for Bill Ackman. The COSIO model, usually it doesn't work. In this case, it feels like it's working, but yeah, usually it does. There's some questions. Salesforce has one. Oracle used to have one, or maybe Oracle still does. The Cisco, there's another one I'm forgetting. Is Michael Saylor a genius? He's looked like a genius in the past. I'll say that. Take that what you may. But in the past, he has also looked like a genius before. It's history doesn't repeat, but it rhymes, gentlemen. All right, let's talk about. Well, no, we're still early. All right, KRC Moon when? KRC or REITs. Well, Moon for either of these is very, you know. So, I think for all REITs, they're going to be they were going to remain challenged until the rate situation is done and clear. So, all REITs. The strongest REITs right now have been the residential multifamily REITs. So Essex, Camden, Mid America, but the office REITs, if you look at KRC, in fact, anytime you get news on rates, that's going to be the main catalyst for them in that given day. But yes, that's for the time being, that's going to be the driving force. And good to see you again. Look at that. He's got his doctor now. Doctor in his name. He's no longer way too good. Stop calling him that. He is now doctor. Fuhad, don't call him this. He's like Gandalf right now. He's showing up in his white robes. He's like, yes, that is what they used to call me. When did I say Intel is better than? Oh, that's not for me. It's like, is that a question for me? Who's this man over here? Well, you came just in time. Oh, hold on. Don't say anything. You came just in time because our next topic is Crocs.
Oh, is it now?
Yeah, and in 10 seconds, I'm supposed to switch over to the Crocs discussion.
So, my brother had a work trip.
Yeah.
And he came home, and he showed me that his wife had gone out and bought all the kids more a set of Crocs, and she bought herself a pair of Hey Dudes. So, like, there you go. Easy thesis.
Well, I always get a little bit nervous with Crocs because, you know, Bacon's a prolific short seller and he's been shorting Crocs and he's been right on it and he's been rubbing it in everyone's face. So it makes me always nervous to take the trade against him.
That's always dangerous to do, not gonna lie.
Yeah. So I think eventually, like he's starting to think about covering his position, but yeah. But more on a serious note.
He told me he was going to double down on it. No.
Oh, he's going to double down. Oh, well, we're screwed then. Oh, he's. I think I'm getting added. I don't know why. Someone. We're in trouble. Get me in. He's going to defend his honor. He's like, you can't say this. Okay.
Okay, so are we going over the bull case on Crocs?
Yes.
So heard you talking some bantha poodoo, keeping it YouTube friendly.
Yes. For the record, Bacon is not short Crocs. That we were gaslighting. We were taking advantage that he wasn't here to defend himself. Okay, so I currently have no exposure to Crocs. However, I may reinitiate, I should say, a position as it's approaching back to $100. And Dr. Latina, who will watch this later, is the reason for the time being that I currently do not have Crocs.
Oh, really?
Yeah, but it's more so because it was small position. I was like, all right, whatever.
Yeah,
We'll
because
come
I
back
know
to
you've
it.
done some shuffling as of
Yeah,
late.
I've done some shuffling, but getting back to Hunter, let's talk about the bull case, because either way, for me, Crocs is not. It's not a core position or a plan to be a core position. It's always meant to be an ancillary position, supportive position.
Mhm.
For you?
Yeah,
For Fabio.
yeah. For Bacon at one point, and just for the record, he
The immaculate rebalance.
Okay, so why wouldn't you make it a larger position?
capital constraints. Because first of all, let's go personal holdings. It's not possible for it to get to what do you define? Let's actually start with that. What do you define as a serious position, percent wise? 5%.
Let's do 5.
Yeah, I go
5. Like I could get it to 5. It would take effort, especially because the personal holdings, I don't contribute new capital to it because everything I have, I put into the holding co when I can put money. And so that makes it a little bit difficult, especially knowing that where Meta's at, and Meta doesn't seem to stop. And so like I could reasonably take capital from that, but Meta's starting to like overshadow a lot of positions.
Which is fine, but you have other positions that become core that
Yes,
aren't.
yes. No, but in fact, it's fascinating to kind of watch what happened, but because Netflix and Meta have grown so much that 5%, some position got kicked out of that. So like they used to be, but then they got kicked out, not because I took any money out, but because others have done better. So I would have to cut something out to add it, and I'd have to cut a couple things probably to get it to 5.
By the way, we'll do a really quick ancillary note. I literally timed the top, take the top on buying an asset in the last few years, and it has been an asset that's been getting crushed since then.
Price of eggs, egg futures.
We'll talk about it later. But with Crocs, we can just go through like the bull thesis, or like it's kind of a simple thesis, really.
It is.
It is a company that made a big gaffe in a acquisition that they did and what they paid for it, and the market has absolutely crushingly punished them for that, as well as thinking that their current product, that their main Crocs shoe, which I am not a fan of. Crocs, like, yeah, my stock would go up if they did well. I probably feel better about the world if it went to 0. I think these things are like a disgrace. But with that being said, they're not going anywhere. I don't think. And they're priced, and I've compared this before. If you compare them to what I'd say are relative peers, and Crocs is a tough thing to call a peer because it's kind of like a niche thing by itself. But you look at Under Armour, you look at Adidas, Nike, any of these things. Crocs comes to roughly a quarter of the valuation at most on these companies, on either EV to EBITDA, price to earnings, price to free cash flow, whatever you want to call. And the thing about Crocs that I like is that I don't think it's fashion. Like, people think that these are, it's the opposite of fashion. It's convenience. And like, I think the bet on people enjoying convenience and laziness for like the foreseeable future is a nice bet, because it seems to continually go towards that route. So at this current price point, in the upcoming year, they're probably going to have a little bit of a pullback because it looks like they'll have some OpEx increase into Hey Dude, trying to flesh that biz out a little more. But even still, they've paid off most of their debt. They're primed to just keep on returning money to you in this form of share repurchases. And so, and they're growing at about an 8% clip, I think, on Crocs. if you do international and domestic combined. So the basic concern I would have with them is you have another big acquisition that takes on debt and prevents capital return to shareholders, because that just, I think where they're at right now, yeah, I mean, if you're going to do a little acquisition here or there, maybe that's fine, little tuck-ins. But you're talking like another Hey Dude or whatever, where you're a $6 billion, $8 billion company taking on a $2 billion acquisition. That's pretty tough. So I think that's the concern with them. I'm not that concerned at this point at its staying power. I think that's kind of established. And yeah, that's roughly it. At some point, this company becomes so cheap, and like I don't see them being super. Yeah, even if they miss earnings or have a guide down or something, they're still, let's say they go down to 10 times, still pretty damn cheap if you're just buying back shares, and buying back in a retiring debt. So that's kind of my thought with them. Like, to me, the valuation kind of seems bonkers, even for them, because I want to say historically they traded at something closer to 20 times earnings, which usually is pretty, that's fair. I'd say, consumer discretionary. I guess, yeah, consumer discretionary. People were really unsure about the staying power of their product. And I think the staying power now has really actually been proven. And I think, yeah, I mean, even like we can look at next 12-month, analyst estimates yields, but even if you just look at like last 12 months, like their last 12 months free cash flow yield, I don't have the yield, I have to do the math. I think 12.5%. So like on an LTM basis, you're at a 12.5% free cash flow yield. Obviously, free cash flow they're expecting to increase going forward. Like I said, EBITDA margins will come down a little bit because of an OpEx increase, but then that'll revert. So I just, before. Go ahead.
No, so it's undoubtedly it's cheap, and even if it's cheap without kind of thinking about the other stuff for a second, but then kind of taking that into account, let's say even if they have some decline, right? You made this point to me the other day, right? What does that look like? So
Decline.
they get some decline. Let's say hypothetically the next quarter comes and they don't grow. It's a 5% drop, 6% drop, 10% drop. What does that start to look like? Right? Are they priced accordingly? Is that what the market's pricing in at this point?
Well, it's gotta be. I don't know.
I also want to mention the Twitter discussion, right? The people saying, "Hey, no, they should do more acquisitions."
Yeah, I hate that.
I was gonna say that would be one of my signs of get the hell out if it's big enough.
I think so. There's a lot of risk in acquisitions. So Deckers, they had some really bad acquisitions. Now, then they hit it out of the park with Hoka's, right? And that just absolutely like sent that stock through the roof. But before that, I mean, they were struggling, I believe. I mean, was it Sanuk, which was like a mistake, and some other ones that they really messed up on. Which, by the way, Sanuk, I guess it's not a boat shoe like Hey Dude, but like kind of reminds me of like a Hey Dude type acquisition. But
it's a long time of like dead money.
Yeah. So the question, like, I think it's okay if you want to start doing acquisitions, but they should be smaller tuck-ins. I don't think you want to be doing the level of Hey Dude.
No.
I
think management has realized this.
And Crocs founder listed because I see the 70s to 10s happening in the cash in. But yeah, I mean, there's risk in having one product line. Sure. Now they have two. They could continue to do smaller tuck-ins, but one, I think at this point, they're so focused anyways on actually integrate. Like, they still say that they haven't fully integrated Hey Dude.
Mm-hmm.
So I don't know why, if you haven't finished your last acquisition, you go out and make another.
Yeah.
Doesn't make sense.
I might not know what it takes to build a brand, but I almost feel like this is a dumb comment potentially coming. So prepare yourself. Warning for everyone listening. What's stopping them from building a brand almost from the ground up? Because one of the issues I found with Hey Dude was the distribution network was mismanaged. Not to the standards that the Crocs management had. And for context, the Crocs CEO currently worked first as a consultant, specializing in that very thing. So he led Crocs through that new era, and really revitalized their distribution network, their supply chains. And he's finding that as being like, oh, this nightmare that Hey Dude basically, threw upon their plate. So then that's sometimes the problem that you end up with when you buy a quote unquote more established brand. Because Hey Dude was more known, even though I didn't know about it. I'm not a good, demographic for it, but
So
nonetheless, I can.
And maybe Hey Dude ends up working out. To me, it seems.
Yeah, it's not written off.
As of right now, yeah. As of right now, it's not good. But yeah. If I had to guess, speed.
It's not terrible either. I mean,
yeah, like you have brand that's already out there and product that's already out there.
Well, not just
as
that. I feel like just
to
saying
do that as opposed to
just make a brand is kind of like. Just making like brands, I feel like is kind of difficult. Like you have no idea what's going to hit, what's not going to hit. And so, that's a lot of R&D and like work into something that just might just be an absolute zero. So like what are so they might find a shoe brand at some point that, and even like well, I guess these weren't really ever big companies. Maybe they just like IPO'd at the right time, like the Allbirds or those kind of shoes that were like big in 2021 and just kind of died off, which would be the single product line risk. But I think Crocs single product line is fine, along with Hey Dude. So I'm not super worried about that. But I mean, because someone asked that in the chat, like to go off of that, there might be some risk in that, but like Under Armour's trading at a pretty massive premium to Crocs even. And I'm like, I feel like there's a lot more risk in Under Armour's products than Crocs.
Can I say I thought they died? I didn't know they were still.
They're still.
I mean, I have Under Armour shoes, but
yeah, not great, Bob, but still paddling around.
Yeah.
Yeah, they're trading at about 33 forward PE. On worse growth, on negative growth, and Crocs is positive growth.
One thing I will say,
let me actually look at this for a second.
Praising Crocs management for a moment. They did do a really good job at paying down the debt.
Yes.
And afterwards, I like to see a management who looks at ways of allocating capital, returning capital to shareholders in the most efficient way, which I think right now is buybacks. And the fact that they've started that up ahead of schedule, because we always knew they were going to get back to it, right? Since I've been following it, but they got into the distribution plan ahead of schedule, I think is a positive note for the management.
No, I agree. That's part of the reason as to why I've stuck with this company for some time now.
Well, and I just got in. My cost basis is like right under 100. Yeah. And I got him recently, but I made a fairly large position.
Is the founder, maybe I don't know, is the founder still relevant?
I don't know.
I didn't see a large.
Let me see.
Andrew Reese is the founder.
Reese? I thought it
Andrew-
was CEO. Yeah, Andrew Reese.
Oh,
Yeah, because he's.
Good-
I know
wow.
he's CEO, but
Google failed here. No. Sorry.
yeah, because I thought it was two
Lyndon
or three
Hansen,
people.
Lyndon Hansen, George Bodecker Jr., and Scott Siemens. All right.
Yeah.
I don't know if they have any relevance still. I don't think they're top shareholders. Let me see.
Yeah.
Yeah. Well,
I
you have a company that starts
don't
off
see
as
them.
where being a fad is a legitimate question,
Oh,
and then 08 and 09 happen.
oh no. What is it? CM?
Oh no,
Guys, I just full ported Nike.
that's got to be a joke.
No, I know he didn't.
That's a joke.
I saw
Dude,
the great
their
intro.
new intro
I-
was so funny.
Yeah, you're a prominent figure.
I have to
in it.
watch. I haven't seen it yet.
The new intro, it was just
Nice.
you're eating yogurt.
I thought it was cereal, but yeah, it was a bowl and a spoon.
No, it's yogurt.
Oh,
He's right. The reason everyone thinks that it's cereal is because some guy said, some guy mentioned and said something like, this one guy's
Well,
eating cereal, but it was actually.
I did the sprinkler.
We'll talk about Nike in a second because I think people naturally ask questions about Nike, Crocs, related. Both are shoe companies, right?
Yeah.
But I have more to say about that. So Crocs, I think the overarching theme is it's cheap. They're doing something about it. The risks are, of course, it is apparel. It's hard to know exactly when trends change. The margins are great. Top of the industry in terms of margins. The gibbets, oh my gosh, the gibbets. Like the gibbets alone, it's like, wow. One thing I've seen that I think is a fair kind of devil's advocate pushback here. Margins expanded from pre-COVID to post-COVID. I have what I think is the answer, but I'll say this first. So what's stopping, or why do we think the margins are sustainable now versus, reverting to the average where they were before?
Pre-pandy.
Yeah, pre-pandemic.
Well, their margins are going to revert some because of Hey Dude.
Yeah.
Mm-hmm.
But
what happens if Crocs brand? Because Crocs brand, the margins have actually been coming up since the Hey Dude acquisition, because Hey Dude
but that's because of gibbets.
shrinking. No, is it gibbets?
Because gibbets have like a 90 to 95% gross margin.
So that gibbets have increased as far as contribution revenue?
Well, yeah, they were pretty irrelevant before.
Irrelevant?
When did gibbets become a thing?
I remember being a kid and gibbets were a thing.
Yeah,
I
like
don't
the gibbets acquisition was back in 06, but
like I don't remember them like being as common as they are now.
Yeah, like
Oh.
the thing that changed as far as like a business model decision was like licensed products. So, for example, like a Hello Kitty themed or a insert whatever like kid IP thing with gibbets and clog. Blah, can't speak. That was relatively recent.
But I think it's that, but I also think like so you look at top line. Well, when was it's kind of hard because Hey Dude might.
I know that one of the reasons why margins improved was the DTC portion of the business grew a lot.
Yeah. And that one I've noticed has fluctuated, the DTC side.
We should say for the record, direct to consumer just in case. Yeah. Someone might be saying DCC. What does that mean?
Yeah, as opposed to them say selling on Amazon or what they retail. Yeah, like I think I've come to appreciate that that number will fluctuate and not to hyperfixate on it, because I think that's what shook me out of Monster was hyperfixating on like product sales. And I think last time I checked, Monster did perfectly all right since.
They're
Monster?
flattish right now,
Oh,
right?
flattish. Oh, okay.
Yeah, they haven't really moved much.
Yeah. Yeah, not to like
I'm just-
muddy things, but
Yeah, I mean that's a fair point on the DTC portion. I'd have to see like how much that actually makes up and seeing if that reverts. On a, I guess the question would be then what causes it to revert? Because I thought it was more of a gibbets. And their gross margins aren't slowing down even. Well, that's because Hey Dude's become, Crocs is probably outgrowing Hey Dude.
This is a good question. Are they making Crocs in China now, not just Germany?
thought
From
it
my
was
understanding,
Vietnam.
yeah, and I think it is multiple places, but
Mhm.
that was another thing that's it's cheap to make, and also one of the things that's supposed to be attractive about it is they can kind of switch. I want to switch over conversation a little bit
Mhm.
to Nike, and then I don't know if you guys want to get into, or Andrew I think wants to get into something.
Okay, Dan, let's go to
No,
Nike.
I was just making a joke. But okay, Nike. What do you want to talk about Nike for?
So real quick, addressing it in relation to Crocs, how do we feel about Nike? Because we got asked, like, let's talk about Nike a little bit, but we don't have to spend too much time because I feel like we can summarize it in 2 minutes.
I can summarize it in like 2 questions.
All right.
Why would you buy Nike over the S&P 500? Why would you buy it over Crocs?
I wouldn't buy it over the S&P 500. I wouldn't buy it over Crocs. I wouldn't buy it over so many things that I find in the market right now.
Oh,
Yeah.
I thought there was like a Dr. Seuss moment. Like, would you eat it
It's
in a box? Would you eat it with a fox?
So
So-
the things I find, yeah, sorry, you go.
I haven't actually ever modeled this out, right? On the face of it, you're talking about 40 times forward earnings, sell side analyst estimates. Like, I've heard there's some people that have like an argument for it. I want to say it's because they kind of shot themselves in the foot really hard by trying to go too hard at DTC.
Yeah.
And maybe reverting that, you then will get growth. I think is the argument. I've heard some pretty like good like pro arguments for it. I just have a hard time seeing it, to be honest.
Yeah.
Like, the thing is, how, sometimes, and I see this a lot around this market cap with companies. Once you get to like 120, 130 billion market cap, as like a clothing company or something like that, it can be tough to like what do you do that can meaningfully move the bottom line? Oh, the one thing you could say is if you see an economic recovery in China, that could be good for them. I don't see that right now.
Buyback. You really move the bottom line diluted EPS.
Yeah. I mean, yeah.
Da-da-da-da-da-da.
At this multiple, it's not going to move the needle too much, but yeah, Nike, I never really understood it that much relative to other opportunities in the market. I've kind of, since I've been investing, always felt that there were other ideas that spoke more. This seems more like I look at my Nike like a marketing company that just so happens to sell clothing and shoes. It's a marketing company that's excellent at marketing. That's their bread and butter. And they just so happen to sell apparel is the way I like to call them.
Andrew, strong man's gonna have some words with you. Shouldn't be S&P, it should be VT. Ryu.
Should be VT. Yeah, and that point on China that you bring up is a good one. It's something that we should at least take into consideration. because that's a large part of the growth story, similar to that of Starbucks. So, okay. I don't know if you want. Do you want to get into the insanity?
Do I want to get into that?
Yeah.
Sure.
All right. We can cover it for 10 minutes and then we'll move on to another topic. But 10 minutes.
Yeah.
Give us the
10
insanity.
minutes. 10 minutes on superposition and entanglement. Okay. All right. So there is a group of stocks. Combined, they do about 60 million a year in revenue. Right now, combined, they have a market cap about 20 billion. I will simply ask you: would you pay 20 billion market cap for a company doing 60 million annually in revenue? Oh, negative growth rates. Correct.
Negative growth rates.
Do they have a profit?
Yeah, because you said revenue.
Profit? Yeah.
No, there's no profit.
Okay.
Oh, off to a great start.
In this economy, I'll take it. I'm kidding.
So, what I'm talking about is quantum computing. So really quickly, what happened that really set this all off? Two things, I think, really. One is kind of just speculation, but really it was Google doing their Willow chip announcement. And so within Google and IBM, there's a quantum computing division. It is a money-losing division, and they know that. And it's not something that they think will make money necessarily, not for a long time. Google put out a press release saying that there's this new Willow chip and it did these really cool things. Elon Musk said, well, that's so cool, and it shot these things off. So like, look at when Rigetti started really popping off, or qubits. What date is that? Is it around December 9th? So December 9th is when they like really like, look at qubit after December 9th. Look how much it shot up the next day. And the reason for that, well, first of all, qubit, quantum computing here, I don't want to say they're a fraud, but they're a fraud.
Doesn't want to say the word, says a word.
So they do, I think, 25,000 a quarter in revenue. That's 25,000. Like, they are worth, I want to say, there's actually a pretty good short report saying that they are straight up just a fraud. But they're 1.5 billion. They came out, so they had a contract with NASA. NASA came out and was like, no, you don't. And there's a lot of like funny things. But they literally were like a beverage company that turned into this, and they don't really have a product. Rigetti is a legitimate quantum computing company. You can add in a QBTS into this chart. You could add IonQ. And I want you to add another one. Actually, I think you only do 5 on Google, right?
Yeah.
Okay. So add QMCO. Now, you can see they all follow roughly the same chart, right? You can see them kind of all going up and going down and everything together, right? And these are all quantum computing companies, right? No, Quantum Corp sells tape drives, but they have quantum in their name. And so they're also doing the same chart, because this is not something built on fundamentals. It's based on idiocracy. So basically, off this Willow chip announcement, I don't know if it's algos, I don't know if it's idiots. They went out, they bought anything they could quantum related. They bought Quantum Corp, they bought QSI, which is Quantum Science, which is a failed biotech company. Nothing to do at all with quantum computing. It's a really funny thing to me, actually, because that company was going to go bankrupt and the stock went up like 700%. And so the founder, who had like a bunch of shares, who he probably wrote off as worthless, just cashed out like 10, 15 million bucks. It's like, oh, cool. And he just like sold all his shares. He's like, awesome. So I am Yes, most of these companies were a SPAC. I think Rigetti was a SPAC. I want to say QBTS was a SPAC. I want to say IonQ was as well. Let me see. Now,
Score
Qubits
one
might have been a
first
direct
math.
listing. Yeah, so IonQ was a SPAC. Rigetti was a SPAC. And at this point, that doesn't really matter, except to say they were low quality and thought of low quality at the time. Now what these companies are trading on, though, is like eventually they'll return to their fundamental value. They're very, very far above it right now. And so I am very, very much shorting these. I advise people to not do what I'm doing. This is do what I say, don't do what I do. Recognize this is a bubble and this is idiocracy manifest, and just stay away. I am of the opinion they will return to fundamental value, which for most of these is a 70 to 80% decline from the current price.
It's just the roller coaster that you have to survive.
Right. And just so people understand too, this is round 2 for me because I shorted at pretty close to the top here the first time around. I don't have like a magic, like a technical analysis or anything. I just kind of said, this looks insane and got lucky. They could have gone up another 100%. I don't know. But, and so, but I like, you know, I did some like quick back of the envelope math. Let's say I just so you understand, look at D-Wave Quantum, because that one we can analyze super quick. They have 300 million in cash, right? Currently valued at 1.9 billion. You take cash value plus 20 times forward sales, assuming they do 100% revenue growth. So basically 40 times historical sales or LTM sales, which is an insane multiple for a cash burning company with questionable growth targets that's been having declining revenues. And you come out to about a 500 million market cap fair value. It's currently at 1.9 billion. You know, so that's basically what is 75% drop at what I would say is a pretty generous fair value. So like in by the way, Carvana, we've said is kind of questionable at best for a long time, but Rigetti, D-Wave, all of these companies too, insiders were dumping shares. When Rigetti got to $2 a share, because these were all penny stocks before this, like Rigetti was at 80 cents. It went up to $2. That's when management did a massive dilution event and was like, they thought it was insanely overvalued at $2 a share. It's at 13 right now. You have every insider that can selling right now. With the exception of D-Wave, like that CEO is a very good like pumper. He puts up press releases every day to pump the stock, and then also does share issuances after those releases. So it kind of tells you where they're really at. So that's kind of like the summary on quantum computing. I think it's insanity. I think it's greed and speculation driving these up. That's kind of where I land with all of this. So, like I said, I would advise people just to kind of stay away. I wouldn't say to probably go and buy these. So, someone in the comments was asking, do they have out of the money put leaps for 26? They do, but you're also going to have to pay a lot for that. So, like,
Thanks, implied vol.
let me just look at the options chain on Rigetti, or as we like to call it, Rigetti.
Rigatoni.
Rigatoni. Okay, so let's look at, do you want to look at January 26th? Talking about Rigetti. Yeah, I mean, a Rigetti $10 put for January 2026, you're looking at a midpoint of $4.20.
For what? For what strike?
$10.
$10 strike. So I could you do a bull put spread?
Bear put spread, you mean?
Or sorry, bear put spread. But
You okay?
you could do like a bastardized version, maybe if you're if you're feeling if you feel so inclined. Like you buy the 2026 put, and then you're gonna try your best. You're gonna take on extra risk for it, but you could sell some puts shorter dated and try to just.
No, actually, what you could do, bear put spread. You sell the. No, that wouldn't probably work either, or maybe it would. Could you sell the 26s and buy the 27s? I don't know. I'd have to go through that. Anyways, like I'm just directly shorting. And yeah, someone says you can get screwed if there's further quant compute press. I play this kind of in a way where it's kind of, some people call it synthetic put. I almost call it a synthetic straddle because if it goes up a ton, like if these stocks went to 1 million tomorrow, I would also make millions of dollars. If they went down to 0, I wouldn't make millions of dollars, but I'd be very happy. And so like it's a bearish direction, but Donald Trump said something quantum related, and no one really. He's not super focused on that. The White House put out the science committee, and in it they mentioned quantum computing, but like no one cared. Synthetic short, sell a call and buy the put. That would terrify me.
That would. The selling call part.
I am
uncovered.
That dude, I would have to snort a lot of cocaine to want to do that trade, man. Like I have to be like so.
Ben lives on the edge. That's
dude.
Ben's like, you guys are pussies. I'll see you in my Bugatti.
Andrew, so you do cocaine, brother? Yes, that's clearly what that means. We don't all talk in hypotheticals or jokes. No, I don't do cocaine. Never have.
So,
never will.
So no iron condors on this. Got it.
No, did you hear about the guy that did the iron condors on The Spy?
Wait, what? Oh boy. Oh boy.
No. Okay, let me just be clear for people in the comments. It was a joke. I don't do cocaine. I have never done cocaine. I will never do cocaine.
Sound a little defensive.
No, I mean, but so, what was I saying?
The way you're positioned.
Oh yeah.
Oh,
so we'll go with that. That's relevant.
Basically, it's you can make it sound really like sophisticated, like people in finance could do, like I'm doing a synthetic put, and it's like, oh, fancy finance. Short 100, you short a bunch of stock and you buy calls at a delta that roughly offsets your short position. So like usually the delta is the implied movement of the option for every cent or movement up. And so if you get a 1 delta, that basically means it's going to move exactly in line with the stock, more or less. And so you can just buy enough calls that's over 1 delta, and then you short the stock, so that if it really runs against you, you're okay. No, shorting is risky. Okay, shorting. Okay, look at that chart and tell me shorting is not risky. But like, and actually the reason that like I'm somewhat worried about like Like IonQ is one that could be like a little scary short because if you look at it, it hasn't been like as much of a parabola as the other ones. I think
I see.
IonQ,
Yeah.
like
261.
yeah, and also like CO it's been more just kind of a lineup. But I still think like it's insanely overvalued. I think people think it's like a more legitimate business for some reason, but I think it's uncertain if that's the case. I did hear their computers are back up and running. Their computer, I should say, is back up and running. But anyways, although there's also a short report out that claims that they are faking actually having a working computer, which is interesting. But yeah, so that's basically that insanity. And I don't want to spend too much more time on it. For most people, these should just be an avoid. You should just stay away. Don't touch. Say, if someone says, hey, I like this company called Rigetti, I'm going to buy it, say, you're an imbecile. And don't buy it.
Price too rhymes with spaghetti, though. It's very strong.
If someone's asking what's the best quantum trash candidate for a short, if you're asking that question, please don't short these. Like, you should be. Oh, let me talk about one more company in this sphere. Look up LAES. This one is also a complete fraud. Seals Q. So, do you know what they just came out with?
No,
in
I
the
don't
last
know
year?
anything.
They came out with the first post-quantum NFT.
Oh, wonderful.
Winner. Yes, NFTs are back. Let's go, baby.
So they are a company with like 4 million of revenue that does EV charging. They do post-quantum chips. They do defense. They do NFTs. They do what else?
Only a matter of time.
Cybersecurity.
NFTs will be back on the timeline.
Yeah, they do all these things, and like if you look at them, this company like really seems questionable if it's a real company or has real people working there. I also saw their advertising for their chief technology officer like on their careers page, which is pretty funny. That's a bad sign. Like you should be having an executive search for something at that level. But these guys, like, they're just straight up. They made like the seal coin. That's like what they made, which is just like I mean, it's like fart coin. You know, it's like just a stupid. And it's really weird. They are a subsidiary of WiseKey, which is WKEY is a stock. WiseKey is only 100 million market cap. These guys are like 500 million. It's like one company basically, but WiseKey owns them and then spun them off. But like all the same executives, and it's questionable if some of these people are even real. Very. This is my favorite one out of them all, probably, that has like a very significant chance of like getting probed by some regulatory body at some point and just dumping all the way to zero potentially. But like I said, just to be clear, the reason shorting it can be dangerous is because like in just so people understand, and I can get into like the IRR math on why shorting makes sense, but like the dangerous part is because if you don't understand how to structure it or at what point you should get out or how to do a stop loss, what would happen if you shorted this company in like November of 2024 and you just woke up one day and it's up 200% against you? Like how much did it go up from that right before the pop to the tip right there? How much was that? Right, December 9th, by the way. So that was 600%. And then what about the next stop all the way up? 2,000%.
Most portfolios wouldn't survive if they're not hedged.
Right. And you'd have to know how to hedge. And here's the thing. Let's say you say, well, I'm just going to do a stop loss. Stop losses don't work pre-market or post-market. This thing could be up 200% overnight and your portfolio is just gone. So like there's reasons that you want to like have a strategy on how you're going to actually do this so you don't blow your account up. Just as a really brief example, if you look at the 1-day chart on Rigetti yesterday, the way I have this set up, Rigetti went up to $16, and then it went down to $13.20. So it's like super crazy intraday volatility. My account's value didn't move that much between those two, except for the fact that I added to some of the short at some point. But it really didn't move that much because of the way that I had it set up. And like, I don't feel like, if I'm going to be completely transparent, I don't feel like giving a course on like how to do this. I also think there's a bit of like, I don't say art, but there's like a bit of art to it almost, where like you have to it's like feel in a way. Like none of this is like a perfect science on how to do it.
Yeah.
Yeah. And like I am completely transparent on everything I do. Like I talk to the guys and everything, but just saying like more than likely you should just stay away from this. Like,
Yeah.
So that's kind of my position on that. Can't believe this thing got all the way to $10.
This and the others. I mean, QBT, that one.
That one's wild, man.
Yeah, that one's wild. And what about the one that's not even a quantum company?
Which one?
The one that's a biotechnology firm.
Oh, that one.
QSI.
QSI, like what? So
There's
just 'cause that's
others that are
quantum, right?
like, I've noticed that are kind of like, I don't know much about this one, but people are saying that it followed a similar chart. It looks like it did is SOUN. I have not looked at this one at all. Chart looks almost the same. So it's called SoundHound AI, but it's got the same chart as these quantum codes.
Yeah.
I don't know if you're pulling it up right now, but yeah.
What stock? What's the ticker?
SOUN. SOUN, sorry.
Oh, sorry. No, it's OUN. Sound.
I don't know.
SoundHound AI.
I don't know anything about them. Look at their chart. It's very similar. Like, do a 6-month chart or something.
The heck?
So, doesn't that look just like the quantum shorts? Or quantum stocks? I don't know why. Even if you do like the related companies in Google, it's like Rigetti. Oh yeah, right there. D-Wave, Quantum are both like related. So I don't know why. I don't know anything about these guys.
I don't know about you, but Big Bear AI. This is the next long, guys. Big Bear AI. What are you buying in 2025? Big Bear AI.
Looks like it was its back.
Yeah.
So there's just like a bunch of like like, to me this screams mania and like gambling, because like I don't think people are looking at this because I don't think anyone's looking at this and saying, wow, D-Wave Quantum, I really like the business model. I like their annealing computers. I like taking marketing campaigns and putting into physical optimization things to find better ways to do marketing, and they're probably just looking at it as like line go up, line will go up again. And I even put like tweets out saying like this is gambling, and most of the people that responded basically said like, oh well, the options chain says it's bullish. Like it sounds very tradery, which traders aren't necessarily gamblers, but I think it's more people like they're not looking at a business, they're looking at this thing's gone up a lot, how do I justify buying it?
If there's a subreddit on the stock.
Oh, all
There
these
probably
subreddits.
Yeah.
Exactly. If there's a subreddit on the stock.
All
It's a
of them are
sign.
subreddits. With a lot of like interesting posts. The Rigetti one's really interesting because there's like a lot of bears in there too. And then they just get downvoted, but it's pretty funny. Yeah, it's a stupidity of Australian miner GME was going on around when US GME was a thing. It's actually. So one of the things I did, just so you understand, and this is actually really interesting. This is the last thing I'll say. So if you look at, let's say QBTS as an example. So let me pull them up real quick.
All right.
Okay. QBTS bottomed near term on Jan 13th, 2025, right? Since then, in 2 weeks, it's been up 60%. Rigetti's more of like it had a more wild recovery. It was down to, let me just pull up the chart here. This is what I find interesting. It was down to 605 on Jan 13th, 2025. As of the close of business on Jan 24, it was at 1320. So that's like a 120% gain. They retraced to the intraday high of almost exactly 80% of the all-time high, like in this run-up on these companies. The time frame and the retracement is the exact same as the first GME pop to sell off to second pop. GME, if you pull up their 21 chart, it went down. Hold on, let me pull this up. Now, I think it went down more, but the retracement was like the same. So my computer's so slow. Okay, so it went all the way
This
up to
one's
$81,
500?
and then it went down. So the drop was more severe. Huh?
Are you saying this one, the 500% or a different one?
Yeah. So then it went up 500%, right? Yeah. No, that one. So it went up. So let me just do the math here. What I'm saying is the all-time high was like 81.25. It went back up to 66, right? Which is, I want to say about 80%. Yeah, 81%. Rigetti peaked out at $20, and that was over a 2-week span. I mean, obviously it looks like it was like 1 day here, but if you look, it was a 2-week span. Yeah, 2 weeks. Right?
Yeah.
If you look at Rigetti, now the intensity wasn't the same, right? And to be fair, there's not as much of a cult around this. It's not as crazy. But it went down. So it went to $20. That's the peak. It went down 70% from that peak, right? To 605. And it had the peak, like the intraday peak on Friday. It was only this time, I guess, 11 days, so like slightly different, but if it's going to open up on Mondays, it's like the same time frame. But it went to an 80% retracement of that all-time high. Like it retraced almost exactly 8%, and that's when it really started to sell off, was like once it hit that. Like this might be me reading into it, but that's why I was kind of looking at this and saying like GME kind of peaked out right here. Like this seems a good time to start to look to like short it again. I was already short. I didn't like perfectly tick the top. But Fabio can tell you guys, I was kind of getting manic, and I was like messaging him like, dude, this right. So, that's kind of just something I found interesting. When you make some comparisons to GME, I think there's a lot of comparisons. Partially because the people that are buying this have no care about the actual science. They have no care about the actual fundamentals of the company. They're going off a line going up and gamble.
I sent you the YouTube channel that's new and it's dedicated to these stocks.
That reminds me, I think I said that reminds me of the guy that made when Beyond Meat and Tattooed Chef was big. He made like a vegan stocks channel.
Oh, vegan food stocks.
Oh, yeah, that person. Shout out Bird Lady Roller Pigeons, by the way.
So that's it. I don't want to spend any more time. We probably spent too much time on these. But like, yeah, it's insanity. There's little pockets of mania and froth everywhere.
Yeah. I kind of feel like it rhymes or reminisces a little bit. Like we're in a time that's reminiscing with 2021. Like I said to the start of the show, I mean, we have meme coins back once more. And there's some craze in the market, some mania in the market. I can't help but feel as though, you know, we're not positioning ourselves well. Broadly speaking, I'm not saying. Hey, what is this?
No,
Oh, making trying to clap. Oh,
no idea.
Any thoughts on recent retail interest in Him X? Was that Hims?
Huh?
That's not Hims. Him X.
Maybe it's
Oh,
Hymex
it's
technology.
Hymex. Yeah. I mean, it fits the new fad among retail investors.
I mean,
Fabless
I can tell you why
semiconductor
retail
manufacturer.
is. I can tell you why they're very interested in this chart. Retail is, anyways.
Yes.
Look at the chart and wonder why retail's interested right now.
Yes. I have no opinion. This is the first time I even see it, so I'd have to look into it. But Fabless semiconductor manufacturer
Actually, this is good.
headquartered in Tainan City.
Actually, I'm gonna go
Oh,
to the Rigetti separate and tell them to buy Himex instead.
AMD. Yes, a lot of YouTubers are talking about this, and we have some colored opinions from some of the members who are semi-inclined, so to say.
Unhindex yourself.
Is the overall sentiment not very bullish from members that are semi-inclined?
Yeah, not on AMD.
Is it cyclical or cyclical component or details?
No, it's just
I think it's just they're super behind, right? And
yeah, they're super behind. The demand gains they get are just simply from that there's an overwhelming amount of demand, and then so they just get the overflow. In CPUs, they're good, right?
Mhm.
But
Oh, yeah.
they're
I'm talking
still,
GPUs.
funnily enough, like Intel still has a stranglehold, but they are losing share. So they are gaining share in CPUs, but in the GPU space, it's night and day still. So you don't have CEOs clamoring over each other to buy AMD's GPUs, but that is the case with NVIDIA GPUs. So yeah, and among YouTube at least, a lot of people are getting really excited about AMD. There's another semi one that I've been recently somewhat converted to. So, but
What is that?
the one that Nash got me in, I'm not in yet, but I'm thinking about buying it. Thinking about buying it.
Well, I know. Is it the one that Nash is hyper bullish on and has been?
Yeah, only because a few others who, obviously, because he's an optimist. But some others who usually are more skeptics were also agreeing with it. There are some challenges though that I have to overcome before I say yes to it, but it's a potential. It's a potential. So I think there's honestly other things that are more exciting, but maybe that one ends up being exciting if I do more research, model it out.
I don't really play in semis, so I don't have an
I
opinion on
know
it.
you
But
hate it. I always go TSM, and you go, ew, disgusting. No.
Yeah.
No, your long, your top long is done monstrous.
And you still won't.
No, and I still,
buy
I'm
it.
so petty. I'm so petty. Oh my god, I'm choking.
I know
I'm so
you
petty.
went and bought their competitor.
Their number
very
one competitor.
Inferior.
Very inferior. No, I have to defend their honor. They are not inferior. I will defend their honor. Your company just owns a bunch of shit co's.
And they don't?
And you're supposed to go
fight. Get your popcorn. Even though it's late night for some time zones.
Well, yeah.
Yeah.
And I'll just say it. Yeah. It's it's KKR. Has been my top holding for a very long time. I think
yes.
What are they at now? 150 billion?
They're going to 200 billion.
I think I have purchases when they were like a $30 billion company.
Very nice.
I also think that you're too focused on the strategic purchases, like strategic balance sheet holdings, and not looking at that as part in a part that they're going to focus on, but just part of the business, because they also have private credit. They also have the insurance business and all these other things that are going. And I'm like, I don't know like how much longer I'd want to be in a hyper concentrated private credit fund. Like when those things really have to start coming to refinancing and maturities, you can only pick out your interest for so long. And then it becomes a problem. So now I'm going to say on the flip side of that, that'll create a lot of good opportunities if you have good underwriting and you are a large player. So like there's two sides to that coin. But I wouldn't want to be super concentrated in it. Like and KKR has exposure to it. You know what's funny though? It's like, so question is KKR viewed now as like the premier private equity fund?
I thought Blackstone still is.
So Blackstone still is. Okay, because that's what I was going to ask. Because I like from a stock perspective, I was talking to Fuhead about this. I said, which his then analysis was he went to you and said buy BX question mark. Andrew said it's a buy, which is not what I said. But I said, hey, like, what do you think about Blackstone? It seems like no one's talking about it. They're large and they're super hyper focused on real estate, which I feel like is harder to potentially scale up, maybe. But they've, from a hype perspective within private equity, it feels like no one's been talking about them. And they do just keep doing their thing. I mean, they're up 50% in the past year, so it's not like they're a dog. Do we think that they start making their plays in real estate and they start, or do we think real estate's going to stay down for a while?
I thought they've been diversifying a lot more.
I'm sure they have been.
So I thought like between them and KKR, they're the two fairly diversified. But
well, Blackstone, let me check, because last I checked, real estate was still like a massive. Let me see. Compared to like KKR, etc. Let me just pull it up here. What do you mean Fu has been looking at Blackstone? I'm just saying that was literally our interaction the other day. I mean, like, Fabio can tell you that was the interaction. I think he like pinged Fabio, like, Fabio, is BX a buy? And Fabio was like, why? And he's like, Andrew said it's a buy. And I was like, it's not what I said. So let me see here.
I have the image somewhere saved.
So it looks like, so here's fee earning AUM. So total AUM, they have about 33% in real estate.
See, yeah, that's a lot more diversified.
That is
than before.
diversifying actually a lot, because they were more like 50 almost.
Yeah, they focused a lot on
credit and insurance. They've really picked up credit and insurance. That's what it is. Actually, their real estate has gone down year over year. Their AUM real estate, which might be because of markdowns.
Yeah, and if they're struggling, bridge.
A bridge too far.
But bridge actually has done fairly well. So
yeah,
maybe on a relative basis, bridge is doing better than Blackstone.
Yeah, actually, they're saying here now that's dry powder.
What's the
dry powder is really in the private equity side.
I have a question for you on the real estate portion. What's the dollar figure in real estate?
325 billion.
Oh wow, I was gonna jokingly say 350. Not that far off.
Even close. It's actually now a smaller segment than private equity and credit. in insurance.
I'll hop off. Thanks for having me on.
You done?
I'm not short Crocs, Bobby. Yeah, I have no value add here.
Oh, yeah, you do. You can stay on. Oh.
So, what was it again? Sorry, the AUM in real estate.
325.
325 billion. No, yeah, so it's freaking massive
Yeah.
in real estate. Yeah, so bridge is like 50 billion. Yeah, so it's completely different size.
Oh yeah. Oh, yeah, the difference in the size between those two is just, yeah.
You see Blackstone as a $1 trillion firm one day?
Uh,
That's what I think you do if you're buying this. If you think you're gonna have crazy returns over the next decade or so, because I feel like there's other PE firms that are just as excellent and getting more growth.
do I think there'll be a trillion? Well, they could. I don't know. I don't hold them.
Yeah, but your baby is.
Yeah, but my baby too is that at that valuation now, where you say, how long till they get to 500 billion?
Yeah, because you're still small enough that 500 billion is still a significant, very significant return.
Yeah.
If that's achieved over even a 10-year period, you'd probably be happy.
Yeah.
Yeah.
Oh yeah. Because that would be because they're what 150 right now.
Mm-hmm.
So over a 10-year period, you're saying I get like a 3.3x.
Yeah, it
over 10
won't be
years?
the same return that you got before. What you
No.
got before was much more impressive, but it's starting to get. Well, the thing is, there's a growing hyper concentration in the top asset managers. So like, there's a lot of growth coming their way because everyone just wants to consolidate capital into them.
Oh yeah, and they talk about that because like it used to be KKR did this, like Blackstone did real estate, KKR did private equity, all these things. So you would go with multi-managers. Well, now KKR and Blackstone, they both do everything. And so why are you going to go to a bridge when you just go to Blackstone for everything? Why are you going to go to Hamilton Lane when you go to a KKR for everything? Why are you going, you can go down the list. And I think that's the problem for the smaller players. Now, I'm not saying there are smaller players I like, but I'm just giving an example of kind of what the...
I can't find this, what I was looking for. Wait, let me search in here. Yeah. Let me see if I get the link here soon. I can.
Link for what?
There's a source that provides the current allocations, or do you have it?
Current allocation.
It's a breakdown. Oh, I like it. Yeah, he gave it to me. So yeah, KKR is right there.
So I'm just looking at my screen. Look at this new thing. That's my problem with Apollo, man. Look at that credit. Like, you're making a concentrated bet on credit there.
Yep.
Which is fine if you're that confident. I don't know.
With Aries, you're making almost that same bet. Stepstone is the secondaries.
Are they public?
Mm-hmm. STEP.
No, I haven't actually looked at them.
Yep.
I didn't realize because I thought the bespoke asset manager. I don't know what that is. So it's actually more and more looking like it used to be that KKR is most diversified. Actually, it's looking like Blackstone is now.
Yep. Blackstone's almost equal across the three major ones:
Mm-hmm.
real estate, private, and other.
Carlyle is also pretty diversified.
Carlyle Group was the cheapest, and they actually did pretty well as well.
I
Recently.
figured
They were very cheap.
Well, they had the whole like hangover. They had a lot of noise in their organization.
I think they're also the ones that are doing share repurchases. None of each one of them has a different flavor, right? So like Apollo, or we'll start with like Blackstone. I think they pay out almost everything. They're just a cash cow. Correct me if I'm wrong, right? But dividends
Definitely historically. I don't know if they've changed that policy since going to this.
To C Corp.
Well, C Corp and less real estate focused. How do you do a payout off of private equity like that frequently?
Yeah, I know, but you just pay out what you have.
Right. Like okay, gotcha.
It looks like they do just pay out what they have. So whatever comes in through the door, they pay out what they have.
Mm-hmm.
And then I know KKR for a fact is low payout, so low distribution approach, which I like because taxes.
Mm-hmm.
And if you can compound it more, keep it in the business. So just let it compound, do the thing. And KKR's answer is on balance sheet businesses plus investing back. Same thing with Apollo. Now, where they differ is obviously Apollo is basically a bank, but not a bank. Yeah. They do have private equity, so it's 18%. They're basically just not in real estate. They're not in real estate at all. But the thing is, Andrew, this is where I kind of get like, technically, within private credit, there can be a lot of real estate exposure.
Sure.
Because you could have real estate as the collateral to that asset. And so you're just taking real estate exposure, but then going a step up the capital totem pole.
By the way, the other kind of diversity that I'd be curious on is geographical. I don't know what KKR is very geographically diverse too, but something might be. But dude, 80 that's such a concentration private credit. Like when I'm going if I'm going to do that, why don't you just do Ares? Because they're smaller, they're more nimble. I feel like they have the best management team like in the industry right now in terms of like what they've been doing.
Yeah.
So why go Apollo at that point? If you're going to get like, I want to make a concentrated bet on private credit being successful by a well-run player, why don't you go smaller who can scale it faster? And the management team who's just been crushing it. Because Ares is still only like a $50 billion company, right?
Almost 60
more than that
now.
Yeah, 60. So why don't you just go with Ares? Why don't I just go with Ares? Shit.
Yeah, why don't you just go with Ares?
Well, because KKR is more diversified, but.
So you're saying, wait. So let's walk to this exercise. So you're saying how confident are you in that statement that you made that Ares will be the best performer?
No. What I said was, if you want to make a bet on private credit,
okay. Oh, I see.
why would you go with why wouldn't you just go with Ares?
Who's raising more capital now? Dude, also valuation.
Compared to market cap, Ares fundraising is nuts. Compared to market cap, I remember, dude, I was looking at them when this was like a $40, maybe it was $50 or $60 stock, and I remember going like, "Damn, that's really impressive fundraising." Like, but like I wasn't super familiar with them at the time. So I don't know what their current fundraising. I'm trying to pull it up. So I like to do like fundraising compared to like market cap and like kind of do and then look at the fundraising trend as well, which I used to keep like an Excel spreadsheet with this because I just pull it up quickly. But these guys are fucking nuts.
Wait, what? Let me put up Alaka's comment. Once I realized the dates I met who worked at Aries being such fucks, I realized it's bullish.
I think I don't know what that means.
I guess he met them and he was like, wow, these guys are assholes. That's bullish.
I mean, probably is. Probably like really high on life.
Damn. You make
So as a
making the
percentage
calculation.
of market cap, as a
Mhm.
percentage of market cap,
Well, maybe you should do
Aries
it
is
as a
doing
percentage
a
of
little more.
Hmm.
Say again, a percentage of what?
a percentage of a previous AUM. Just like what's the AUM growth
Okay,
percentage?
that's fair. That's fair. That's fair. That probably makes more sense. Okay, so we have 140 billion LTM for Apollo, and then Aries didn't give LTM, but they said year to date on 11/1 was 64 billion.
So half.
But
Apollo's not
Aries
even double
Aries
their
has
size.
2 more months. Aries has 2 more months because Apollo was saying last 12 months.
Wait,
And
sorry,
Aries was
I
saying
didn't even do my math right. Apollo was how much?
140 billion.
No, that's more than double.
But Aries was only for 10 months.
Is how much can they do in 2 months?
In Q4, probably a lot.
Damn it. What about the year before? I'm asking a lot, but
let me pull up because that's a good question because normally Q4 is when you do most of your fundraising. Like it's I won't say most of your fundraising. It's the quarter with usually the highest fundraising. So they raised 74 billion in 2023. And they were at 64 billion, which was, and I think they said they were ahead. They had third-party fundraising. Oh, that's Apollo. Whoops. Oh, yeah, that's because I pulled it. So 2023, they did 74 billion. I want to say they said they were seeing momentum. We're tracking to have our best year ever for fundraising. So they're definitely going to be over 74 million or 74 billion of funds raised.
So about half. But
I'd like say it's 80. So a little more than half. So yeah. So as a
percentage of AUM, what was Aries again? It was like 500 billion.
460, I think. Hold on, let me check.
I think Apollo's just about to reach 1 trillion.
As of September 30, our AUM was 464 billion for Aries. I'm not seeing a note on the AUM for Apollo, but let's say you think it's 1 trillion?
It's just under. It's under 1 trillion, but so their goal, I think their goal for like 2027 was like 1.5 trillion or 1.
So you have Aries raising. So let me do it like this. Aries raising about 17% of AUM in the year, and Apollo's raising, if we do 1 trillion,
it's less than but it's less than
14%. Okay,
it
so
might
it's
it
not,
might
it's
be
not too far
end up
off then.
higher. Let me see what Apollo's. Yeah. In 2024, 733 billion.
Okay, so it's actually pretty damn close. actually.
There we go. That's what I'm saying. I remember it being not that far apart.
But
The concentration, I know.
you have, but it's easier to move around a smaller amount of funds, and with the management team that Ares has,
Well,
I don't know.
but private
I think
credit
if you're
scales.
if
That's why they're both doing it. You can push so
I
much
mean,
capital into
sure,
that
but
product.
sure, anything scales, but I do think like there is a better core of like it's harder to find good opportunities to lend to as you get larger and larger. I mean, but you're right, it scales.
There's a statistical rule, I forget. It's like, but the in English it's just like when you get really large, you basically just collect the average risk of the product.
That kind of makes sense, actually.
And that's what banks eventually just end up becoming. Like you just collect the average risk of the product. So like then Apollo has, I think Ares has a really good delinquency rate too, but Apollo's is like 0.1%. And usually, like I said, the bank guys I follow, they always they praise Apollo. They hate no, like I'm not kidding, Andrew. They hate private equity and private credit. They have nothing good to say ever. And then the one time they mentioned, like, no, but Apollo has good underwriting. I was like,
okay, then maybe that's you roll with that then.
No, but they also said Ares. I'm not gonna also
okay.
deny. They
They
also
said
said
Ares and Apollo.
Ares and Apollo
Did they
in
say
private
KKR?
credit. No, they did not mention. I'm sorry.
Damn.
But I guess maybe they just weren't thinking about them because these guys are like the private credit guys. Because Apollo's like what? Yeah, it's 81%. So you take 700. They're the biggest.
Apollo has to have good underwriting standards. You
Yeah.
can't have 80% concentration and not have good underwriting standards. You're gonna get killed.
So
I don't know. I think Apollo is fine. I don't have anything against Apollo. I've been a KKR stan. I mean, I have been, right?
I love that phrase.
It's what I've been. I mean, I don't know what to say, but I've been a KKR stan. Yeah. For Lakers and for the Apollo drop was not getting included in the S&P 500. That's why it dropped in August. I'm pretty sure.
But it got included now.
Yeah, but you'll see a pop from that. But in August, like there was a speculation that it would get included then, and it didn't. So it sold off, and then it did get included. So then
Dude, that was the buying moment. That was the buying moment. You know what? And for some reason, I don't know why, but I guess I kind of know why because I'm about to say why I think why it is. But Apollo does get, even though like we just stated, they're growing AUM like Ares by percentage, and their multiple is the lowest.
Yeah.
I think that's because the market also, I don't know, this is the insurance business because they're the number one in the right underwriting of those insurance products. I think they have the biggest player by far. But
no, I mean, yeah, it's.
I just know that if KKR
I
dominates,
see the Apollo pitch. Like I'm not hating on it. I like the
going to be like, I told you. You can already see it.
I
2
mean,
years from now.
Hey,
2 years from now, KKR is going to be $500 billion. Apollo is going to be just 200, and you're going to be like, I told you.
I told you.
It was just subtle.
See, I have the ultimate hedge here, right? Because like KKR does what Mike told you, and then people like if KKR only goes up, a certain amount, and Apollo outperforms, they'll be like, well, I mean, I've had KKR since so long, it's done so well, anyways, and everyone will be like, yeah, that's good cope, okay, and then move on.
There's also TPG down there. TPG is trying to break into that private credit space, but like from you know who knows people or read the discussions in the space. Yeah, TPG is still not considered top tier, and there's disgruntlement in there, but yeah. And Blue Owl. Well, Fuhat's asleep, I guess, so I can talk bad about Blue Owl, but
I've heard some really questionable things about their underwriting and stuff, so I don't know.
Yeah, I feel like Blue Owls, when private credit has an issue, it's going to come from companies like Blue Owl.
Yeah, I agree.
But Brookfield, who knows about Brookfield? Oh, we didn't even mention Brookfield. We just ignored Brookfield. I love that. And I think
also,
Brookfield.
This is Brookfield Asset Management, so it's BAM. But like Brookfield's so complicated. I'm like, well, is that just BAM? Is that the whole like? I think so.
Yeah. Does Brookfield have more AUM than KKR?
Dude, I have no idea. But dude, it makes so much sense that Bill Ackman bought Brookfield, because I swear this guy likes to buy the most complex shit in the world. Like, because I think he just likes to be like, oh, I bought this thing. Look, it's like so complex. And I understand it. Like, just do like this mental masturbation off to himself. Like, I do not like. He bought Brookfield. I was like, of course he did. Just like he bought Howard Hughes and all these like insanely other complex structures.
Lakers and 4 accountants hate Brookfield, but Bill Ackman loves it. Yep, that's it. That's the thing.
Yeah.
All right. With that being said, thank you guys so much for joining us in today. If you guys are interested in joining the Capital Mindset Club, the link is in the description here on YouTube, where you get access to our portfolios and all of our pitches that we provide. All right. I will try to come back on here live next week. I think I'm going to have time next week, so that'll be fun. And we'll see if anything develops. The world will not end, hopefully. The markets crash tomorrow.
Yeah.
Or not tomorrow. Well, yeah, today's Sunday, so yeah, tomorrow's correct. So, yeah. And we'll be seeing you guys on the next one. I'll leave you guys out with an outro.
Okay. We'll do it live. Okay. We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.